Netflix stock tanked after Q2 earnings. Find out why in today's presentation.
All right, let's dive right into this, because today we're unpacking a real honest-to-goodness business mystery. Welcome to this explainer on Netflix's Q2 2026 earnings. Now, on paper, this looks like a massive triumphant moment for the streaming giant. We're talking about a quarter where they just absolutely crushed it financially. But when the numbers actually dropped, the market's reaction told a completely different story. It's the ultimate corporate paradox, right? Record profits, but a crashing stock. Why? How exactly does a company win the quarter so decisively and yet simultaneously get penalized by Wall Street? Well, to figure out this disconnect, we need to strip away the flashy headlines and look at exactly what the data is telling us, both about Netflix's past 3 months and, maybe more importantly, what investors believe about their future. So let's get into Section 1, a blockbuster quarter inside Netflix's Q2 2026 results. Let's examine the first half of this paradox and look at the objective financial foundation they just laid down. That is a staggering $12.56 billion in revenue for a single quarter. To put that into perspective, that represents about a 13% year-over-year increase. We aren't talking about a scrappy startup trying to find its footing here, We are talking about a mature, massive media behemoth that is somehow still managing to grow its top line at a double-digit pace. But what is truly mind-blowing here is their efficiency. This 27.1%, that's their net income margin. Think about what that actually means in the real world. For every single dollar you pay them for your subscription, they get to keep roughly 27 cents as pure, unadulterated profit after every single expense is paid. That efficiency resulted in $3.4 billion in net income, literally cash in the bank, proving that their whole operating machine is just incredibly finely tuned right now. And honestly, this brilliantly illustrates just how far they've come. We all remember Netflix then, right? The era of just burning through cash, taking on massive debt, and focusing almost entirely on subscriber growth at literally all costs. But Netflix now, it's a completely different beast. It is a highly efficient operation, consistently generating billions in quarterly profit. They've successfully made that super difficult leap from a high-growth cash burner to a straight-up cash-printing media empire. Which brings us to Section 2, the plot twist, the expectations game. Okay, so this is where our mystery truly deepens. If the financials were undeniably good, what actually happened? Well, despite the incredible quarter we just walked through, Netflix shares fell sharply. We saw a really surprising after-hours stock drop of 8 to 9%, and those losses actually briefly reached around 11% the very next trading day. No way around it, a sell-off of that magnitude implies something went terribly wrong. But as we're going to see, the sell-off had very little to do with the quarter Netflix had just finished reporting. Comparing their forecast to Wall Street's expectations is really the key to solving this mystery. See, investors weren't looking backward, they were looking forward. Netflix projected their third quarter revenue to be around $12.86 billion, with earnings per share sitting at about 82 cents. Now, make no mistake, those are perfectly healthy numbers. But look at what Wall Street was expecting. They wanted a faster pace of revenue growth and higher earnings per share. Management's guidance was just a little bit softer than anticipated, kind of hinting that the business might be entering a more mature, slightly slower growth phase. So the absolutely crucial takeaway here is this. Public markets price future expectations, not past performance. If you take away just one lesson from this entire explainer, let it be that. A company can completely shatter records today, but if investors believe tomorrow's growth won't be as explosive as they initially thought, the stock is going to get punished. Netflix didn't have a bad quarter. They just didn't promise an impossibly perfect future. And compounding that slight disappointment was this announcement. Starting in 2027, Netflix plans to reduce how often they publish their detailed viewing hour data. They're moving from twice a year down to just annually. Now, while this doesn't change the actual fundamentals of their business, people are obviously still watching just as much, investors got slightly spooked by what they perceived as a step backward in transparency. So combined with that softer guidance, it basically created the perfect storm for a stock sell-off. All right, let's move on to Section 3, the reveal. Netflix's evolving growth engines. If we look past that short-term market reaction, Netflix is rapidly transforming beyond just being a simple subscription service. First off, their core product, the content itself, is highly diversified. With Q2 hits like I Will Find You, Legends, The Polygamist, the Korean drama Teach You a Lesson, and the animated feature Swapped, They aren't just relying on one massive, expensive American blockbuster to drive all their engagement anymore. They're consistently producing hits across multiple genres and multiple countries. Actually, you could argue their international programming pipeline is their greatest competitive advantage today. Then you've got the massive momentum of their ad-supported tier. Netflix reaffirmed its expectation of generating approximately $3 billion in advertising revenue for 2026. I mean, wow. For a company that for years and years relied entirely on subscription dollars, successfully building a $3 billion secondary revenue stream is monumental. It's a real game changer that significantly boosts their long-term profitability. And on top of that, they are stepping into the live arena. Netflix is strategically expanding its live programming, notably highlighting upcoming coverage of the FIFA Women's World Cup. And live sports do something truly magical for a network. They create incredibly lucrative, premium advertising opportunities, and they drive real-time appointment viewing that standard on-demand content simply cannot replicate. They are also practically applying emerging tech. Look, when people hear generative AI in Hollywood, they tend to panic about writers and actors being replaced, right? But Netflix is defining and using it as a creative productivity tool. They actually disclosed it's currently being used in around 300 titles this year, specifically to accelerate visual effects, reduce production costs, and streamline post-production workflows. So it's really about efficiency, letting creators spend way more of their budget and time on the actual storytelling. Furthermore, they are planting seeds for the distant future with continued long-term investments in gaming and podcasts. Now, sure, while these segments aren't exactly moving the multi-billion-dollar needle just yet, they clearly signal management's ambition. They don't just want to be where you go for movies and TV anymore. They want to be your default, all-encompassing global entertainment platform. Which leads us to Section 4, the climax, betting on the future. So, considering all this, how does Netflix management actually view their own valuation amidst all the market noise? Well, they put their money exactly where their mouth is. During the quarter, Netflix executed a massive $4.7 billion share buyback. Think about that. That is the largest quarterly buyback in the entire history of the company. In the corporate world, actions definitely speak louder than words, and a buyback of this sheer size is a screaming signal to the market. It proves management believes their business remains fundamentally undervalued, and importantly, it proves they have the enormous cash flow required to return billions to shareholders while still funding all that future growth. So as we wrap up this explainer, I really want to leave you with a provocative question to ponder. Based on everything we've looked at today, the industry-leading margins, that massive ad tier, the push into live sports, gaming, and AI, is Netflix still just a streaming app on your TV? Or are we witnessing the maturation of a truly diversified global entertainment empire? Wall Street may have panicked over a slight dip in future guidance, but honestly, the underlying machinery of this company has never looked more powerful. Thanks so much for diving into the data with me today, and keep exploring.